Corporate America just hit $1.8 trillion in debt. Not government debt, corporate debt. And when this bubble pops, the middle class gets destroyed. Not the rich, not the poor, the middle class. This isn't about housing bubbles. This isn't about tech stocks. This isn't about cryptocurrency crashes that wipe out speculative traders. This is about the systematic destruction of middle-class retirement savings through corporate debt collapse that's mathematically inevitable. 1.8 trillion, that's more than the GDP of Canada, more than the market cap of Apple and Microsoft combined, more debt than the entire corporate sector carried during the 2008 financial crisis. And it's all coming due at the worst possible time. Here's what nobody's telling you about this debt. It's not held by banks that can absorb losses. It's not owned by hedge funds that specialize in distressed investing. It's packed into the retirement accounts of middle-class Americans who have no idea what's about to hit them. 401k plans, pension funds, target date retirement funds, bond mutual funds, all loaded with corporate debt that was issued when interest rates were near zero. Debt that seemed safe when borrowing was cheap, debt that becomes unpayable when refinancing costs triple overnight. The mathematics are brutal. Corporate America issued most of this debt between 2010 and 2022. Average interest rate, 2.3%. Current refinancing rates, 7.8%. When companies borrowed money at 2%, they could service debt payments easily. When they have to refinance at 8%, the payments become impossible. This is where things stop making sense if you believe what financial advisors are telling their clients. If you trust that corporate bonds are conservative investments, if you think investment-grade debt provides safety for retirement savings, because what's about to happen isn't a market correction, it's wealth confiscation. Systematic transfer of middle-class savings to corporate creditors through bond defaults that destroy retirement account values while protecting executive compensation. The timeline is already set. Over $847 billion in corporate debt matures in 2025. Another $623 billion comes due in 2026. $398 billion in 2027. Companies that borrowed cheaply during the zero-rate era must refinance at rates that make their business models mathematically impossible. The refinancing crisis isn't theoretical, it's happening now. Bed Bath & Beyond, Silicon Valley Bank, First Republic, Credit Suisse, all recent examples of what happens when cheap debt becomes expensive debt. All warnings of what's coming for the entire corporate sector. But those were just appetizers. The main course involves companies that middle-class Americans recognize. Companies whose bonds fill retirement accounts because they seemed impossibly safe just 2 years ago. General Electric, $67 billion in outstanding debt. Average rate, 2.1%. Refinancing requirement over next 3 years, $23 billion at current rates. Annual interest costs increase from $340 million to $1.8 billion. Impossible to service without massive asset sales or bankruptcy. Ford Motor Company, $156 billion in debt. Refinancing needs, $47 billion by 2027. Interest cost explosion from $1.2 billion annually to $6.8 billion. No automotive company can absorb a 5-fold increase in financing costs while competing against companies without comparable debt loads. AT&T, $198 billion in outstanding debt. The most indebted non-financial corporation in America. Refinancing requirements exceed $78 billion over the next 4 years. Current dividend payments become mathematically impossible when debt service triples. These aren't distressed companies. These aren't speculative investments. These are blue-chip corporations whose bonds have been marketed as conservative retirement holdings for decades. Companies that financial advisors recommended specifically because they seem too big and too stable to fail. They're about to prove that too big to fail doesn't apply when mathematics overwhelms management, when debt service exceeds operating cash flow, when refinancing becomes impossible at sustainable rates. Here's how the wealth destruction unfolds. Corporate bond prices collapse as investors realize refinancing is impossible. Retirement accounts holding these bonds lose 40-60% of their value overnight. Not gradually, suddenly, when reality overwhelms comfortable assumptions. Pension funds face immediate funding shortfalls. State retirement systems discover their conservative bond allocations have evaporated. Corporate 401k plans find their stable value funds aren't stable when underlying bonds default. The middle class absorbs these losses directly, not through stock market volatility that affects discretionary investments, through retirement account destruction that eliminates decades of careful savings, money that can't be recovered, security that can't be rebuilt. Meanwhile, the wealthy remain insulated. High net worth investors don't hold corporate bonds and retirement accounts. They own equity stakes in companies that benefit from competitor bankruptcies. They hold real assets that appreciate when paper assets collapse. They have access to distressed debt funds that profit from corporate failures. The poor remain unaffected because they don't have retirement savings to lose. The rich remain protected because their wealth is structured to survive debt crises. Only the middle class holds enough retirement savings to be destroyed by corporate bond collapse, but lacks sufficient wealth to diversify beyond traditional retirement vehicles. This represents the perfect wealth transfer mechanism. Corporate debt crisis that systematically destroys middle-class savings while concentrating assets among those sophisticated enough to avoid the trap or wealthy enough to profit from the collapse. The pattern is already visible in recent corporate failures. When companies like Bed Bath & Beyond collapsed, executives received millions in retention bonuses while bondholders lost everything. When Silicon Valley Bank failed, uninsured depositors above $250,000 were made whole while shareholders were wiped out. The same pattern will repeat on a massive scale when the corporate debt crisis accelerates. Executive compensation will be protected through bankruptcy proceedings. Secured creditors will recover partial value. Retirement account holders will lose everything with no recourse and no recovery mechanism. But here's what makes this crisis absolutely devastating for economic stability. Corporate debt defaults don't just destroy retirement savings, they trigger recession through reduced business investment, mass layoffs, and decreased consumer spending. When companies can't refinance debt, they stop investing in growth. Capital expenditures get canceled, research and development gets slashed, new hiring stops. Existing employees get laid off to preserve cash for debt service. The multiplier effect devastates middle-class employment exactly when middle-class retirement savings are being destroyed. Job losses combined with portfolio destruction create depression conditions for the middle class while leaving other economic classes relatively unaffected. This isn't speculation. This is mathematical projection based on debt maturity schedules and current interest rates. The refinancing crisis is inevitable because the debt exists and the rates have changed. The wealth destruction is predetermined because retirement accounts hold the debt that must default. The Federal Reserve created this crisis through zero interest rate policy that encouraged massive corporate borrowing. Companies issued debt not because they needed capital for productive investment, but because money was essentially free. Stock buybacks, dividend payments, executive compensation, borrowed money used for financial engineering rather than economic productivity. Now the bill comes due. Companies must refinance at rates that make financial engineering impossible. Debt that was used for stock manipulation becomes debt that threatens corporate survival. Zero-rate speculation becomes high-rate desperation. The Fed cannot solve this crisis through monetary policy. Lowering rates would trigger inflation that destroys middle-class purchasing power through different mechanisms. Keeping rates high guarantees corporate defaults that destroy middle-class savings directly. Either choice devastates middle-class wealth. The only difference is the transmission mechanism. Inflation or deflation, currency debasement or debt destruction. Both paths lead to middle-class impoverishment while preserving wealth for those positioned correctly. Corporate executives understand the mathematics and are positioning accordingly. Record insider selling as executives, convert equity stakes to cash. Before debt crisis destroys share prices, golden parachute arrangements that guarantee compensation regardless of corporate survival. Personal asset protection strategies that insulate individual wealth from corporate failures. The timing suggests coordinated preparation for systematic corporate defaults, not accidental timing. Planned extraction of executive wealth before retail investors and retirement savers discover their holdings are worthless. Meanwhile, financial advisors continue recommending corporate bond funds as conservative retirement investments. Target date funds continue loading up on investment-grade corporate debt. Pension consultants continue modeling corporate bonds as safe assets with predictable returns. All while the debt maturity wall approaches and refinancing becomes mathematically impossible for over-leveraged corporations. All while retirement accounts accumulate the very assets that must collapse when reality overwhelms financial engineering. The warnings are everywhere for those who understand debt mathematics. Corporate earnings declining despite record revenues as interest costs consume operating cash flow. Credit rating downgrades accelerating as agencies recognize refinancing risks. Corporate bond spreads widening as markets price in default probabilities. But retirement savers don't see these warnings. They see stable account values and steady distributions from bond funds that haven't marked their holdings to market. They trust financial advisors who don't understand the refinancing crisis. They believe corporate bonds remain safe because nobody explains the mathematics of debt maturity at higher rates. The education gap ensures maximum wealth destruction when reality arrives. Sophisticated investors exit before crisis becomes obvious. Retail investors hold until defaults destroy account values. The transfer mechanism works perfectly because information asymmetry prevents timely response. Corporate America borrowed $1.8 trillion at rates that no longer exist. Middle-class America holds that debt in retirement accounts that assume it can be repaid. The mathematics guarantee wealth transfer from savers to borrowers when refinancing becomes impossible. The corporate debt crisis isn't coming. It's here. The refinancing wall isn't approaching. Companies are hitting it now. The wealth destruction isn't theoretical. It's mathematical certainty based on debt schedules and interest rates. Retirement account holders have months, not years, to recognize the pattern and reposition before defaults destroy decades of savings. The corporate debt bubble is popping in real time. Middle-class wealth is the target. The only question is whether middle-class savers will understand the mathematics before their retirement security disappears into corporate bankruptcies that were designed to protect everyone except the people who bought the bonds. $1.8 trillion in corporate debt, refinancing at triple the original rates, held in retirement accounts that can't absorb the losses. The wealth destruction mechanism is activated. The middle class is the target, and the countdown has already begun.